Subcommittee on Economic Policy. The rapid collapse of three banks, Silicon Valley Bank, Signature Bank, and First Republic Bank, was a shock. These three bank failures together put more assets at risk than the 25 bank failures in the 2008 crash. Silicon Valley's bank failure was another symptom of what has become a predictable string of failures in the governance of the Federal Reserve. SVB's collapse and other bank failures it triggered forced the FDIC, the Treasury Department, and other regulators to rush to the rescue to avoid implosion of our banking system. So far, the FDIC Insurance Fund has suffered billions of dollars in losses, and as a result of the bailouts, America's biggest too-big-to-fail bank just got $200 billion bigger. The failure of those banks was a first-order management disaster. Same old story. The executives took on too much risk, got too greedy, and blew up their banks. Those executives need to be held accountable, and I'm working on bipartisan legislation to claw back money when executives take big bonuses for blowing up their banks. But look deeper. The implosion of all three banks are rooted in the failure of those banks' regulators and supervisors, most notably the Federal Reserve. The Fed's own report on the SVB failure identified problems high and low, finding that as SVB got bigger and bigger, the Fed's Board of Governors, under the direct leadership of Jerome Powell, weakened banking regulations. This is exactly the kind of deregulatory shift I warned about in 2018 when I opposed Powell's nomination as Fed chair, and again in 2021 when I said he was a dangerous man to keep at the Fed. Now, notably, the Fed's report also laid blame at the feet of Congress for passing legislation to weaken bank rules, an agenda that Chair Powell eagerly endorsed. The Fed's report found that bank examiners at the San Francisco Fed, which was SVB's regulator on the ground, followed orders from the Fed and backed off, allowing SVB's executives to pile on more and more risk. Now, the San Francisco Fed and the Board of Governors are pointing fingers at each other, playing a pathetic game of not it, while they each try to deny accountability. The Fed is independent within the government, and it needs to maintain that independence when it comes to doing its primary job of setting interest rates. Independence should not be conflated, however, with a total lack of accountability when the Fed and its leadership make serious mistakes. Unfortunately, the Fed has faced little accountability. In recent years, a growing list of scandals has tarnished the Fed's reputation and its credibility. In 2021, high-level Fed officials were embroiled in a scandal involving stock and other financial trades made even as the Fed took extraordinary action to right the economy during the COVID pandemic. The Fed responded with a sham investigation by the Fed's own Inspector General, an official hired and fired by the Fed itself. This investigation failed to look into key aspects of the scandal. Even when the Fed IG found that there was improper trading in Chair Powell's accounts, it imposed no consequences. And when the Congress tried to get information from the Fed board and from regional reserve banks on the scope of this scandal and the response, we got the cold shoulder. The Fed simply refused to turn over key documents and information to Congress and stopped any outside investigation dead in its tracks. And that's not all. Reports have surfaced about Fed leadership giving secret speeches and sensitive information to bankers and bankers' wealthy clients. We learned that, unbelievably, the president of SVB sat on the board of the San Francisco Fed up until the day that the bank failed. This culture of corruption at the Fed has already undermined the Fed's credibility with the American public. And the hearing today will discuss proposals that would make the Fed more transparent and more accountable in order to try to help restore some of that credibility. I've got an idea, a bipartisan idea that I am introducing with Senator Rick Scott today. Get the big bankers off the Federal Reserve boards of directors. And there's more. Senator Scott and I also introduced a bill, which was included in a separate bill with Senator Tillis, to give the Fed a true Senate-confirmed independent inspector general to serve as an agency watchdog. Mark Bialik, the current Fed IG, is here today. Mr. Bialik, I appreciate your joining us because I know you have a busy schedule. And I want you to know that my concern about your current role is not personal. My concern is institutional. You were chosen by the then Fed Chairman Ben Bernanke in 2011, and you serve today at the discretion of Chair Powell and the board. In other words, you are supposed to be the watchdog of exactly the people who hired you and who have the power to fire you. That dynamic tends to create watchdogs that don't bark. At best, you are in an impossible, compromised position when it comes to investigating wrongdoing at the Fed. To restore public confidence in the Fed, we need a strong, Senate-confirmed inspector general to conduct rigorous, independent oversight. I appreciate your joining us today, and I look forward to discussing these and other matters. So we are now ready for your opening statement, Mr. Bialik.
Thank you, and good afternoon, Chair Warren, Senator Scott, members of the subcommittee. I'm Mark Bialik, the Inspector General of the Federal Reserve Board and the Consumer Financial Protection Bureau. I very much appreciate the opportunity to be here today to discuss oversight and accountability for the board. In response to the disclosure of questionable trades by board and Federal Reserve Bank officials, our office did initiate separate investigations of these officials, as well as an evaluation of the board's new trading rules that were put into place. We expanded our investigation of board officials to include Chair Powell's trading activities based on public reporting. As soon as it was closed last summer, we released our investigative findings regarding the trades of board officials, including Chair Powell. However, we did not release the details of our investigative steps and techniques because we must protect the integrity of our other ongoing and closely related ethics investigations of senior Federal Reserve Bank officials. I understand there is criticism about the independence and thoroughness of our ethics investigation of senior board officials, given the limited information that we disclosed. But I want to emphasize that we independently and thoroughly investigated this matter. We pursued the facts wherever and to whomever they led. We didn't just take people's word for what was told to us about the activities. Rather, we thoroughly reviewed relevant records, including over 3 million emails, financial disclosure reports, trading data, brokerage statements, and for all of the relevant trading activities. We also consulted with OGE, the Office of Government Ethics, which is the federal government expert on government ethics. All of this factored into our findings and our recommendations that we released, and I stand by our work. Once we conclude our investigation of Federal Reserve Bank officials, I am confident that we will be in a position to provide a detailed explanation behind the determination of our investigative results. To reform Federal Reserve oversight, Legislation has been proposed to convert our office, as you mentioned, to a presidentially appointed and Senate-confirmed position. This is ultimately, of course, a matter for Congress to decide. I just want to emphasize that under our current structure, we have the same authorities as other IGs to audit and investigate without interference from our agency head. We have unfettered access to all agency records and documents, subpoena authority, law enforcement powers, such as executing search and arrest warrants, and the ability to hire our own staff and control our own resources. We have the same reporting mechanisms at our disposal if attempts are made to resist or object to our oversight activities or to significantly delay our access to information. In conclusion, we exercise our independence most directly in how we perform our work. Determinations on audits and evaluations and investigations we conduct are made by us alone. No board chair has resisted or objected to our oversight work since I have been the IG. If that were to happen, I would not hesitate to report that to Congress. The breadth and impact of our work is solely attributable to the OIG staff, who dedicate themselves to doing the hard work of developing independent findings and recommendations to ensure that the board is held accountable and operates effectively. I am so very proud and thankful for the work they do every day. Congress is a key stakeholder for us, and of course, we always welcome your feedback on risk areas that you see facing the board or the CFPB. This concludes my statement, and I'd be pleased to respond to any of your questions.
Thank you. Senator Lummis?
Thank you, Madam Chair. This year, we've seen the collapse of America's 14th largest bank, First Republic, and the 16th largest bank, Silicon Valley Bank. These collapses have been due to failures by bank executives to manage the risks of their institutions. We've also seen regulators fail to effectively supervise each institution and fail to escalate concerns until they are resolved. I'm proud to co-sponsor the Financial Regulators Transparency Act with Chair Warren and Senators Rounds and Tillis on this subcommittee. It will bring much-needed reforms to strengthen accountability of the Federal Reserve. For example, regional Federal Reserve banks would be subject to the Freedom of Information Act, an essential tool for government accountability. And I think this is tremendously important to the public as well as to members of Congress. It's been a true source of frustration for us that our letters requesting information go unaddressed and unanswered. Mr. Bialek, the Fed's OIG is required to complete a review of the agency's supervision of a failed institution when there's a material projected loss to the Deposit Insurance Fund. So when can we expect a report on recent bank failures?
Thank you for the question, Senator. We opened up a review of SVB. Of the three banks you mentioned, that is the only one that is supervised and regulated by the Fed. The other two are supervised and regulated by the FDIC. So as it relates to SVB, once we heard about the condition it was in and the likely failure at the time, back in mid-March, we opened up a review, anticipating that there would be a failure declared, which it was last Friday, and the amount. And that turns into the material loss review then that you mentioned. But because we got a jump start on it in March, we are now projecting and promising to complete this review by September of this year. We are doing a deep dive into all of the issues that have been bandied about in the media and elsewhere in hearings about the issues, the likeliest root causes of the failure, the supervisory actions or inactions that also led to this condition that we find ourselves in. So we are in the midst of that review right now.
Thank you. You've already answered my next couple of questions, so I appreciate it very much. There are 51 open recommendations that the OIG has made to the Board of Governors. A dozen have been open for more than 5 years, and one stretches back to 2016, meaning the Fed has had years to address concerns your office has identified and hasn't taken action. So I doubt the federal supervision staff would be happy about a member institution that has an unaddressed MRA or MRIA from 2016. Has the Fed board committed to closing all open issues?
Well, let's make sure we're talking about the same thing. In terms of our open recommendations, if you were referring to the IG's open recommendations, that is something that we have ongoing discussions with the responsible officials at the Fed to assure ourselves that they are taking action in a timely way to address those types of recommendations. Many of them, and I think the oldest of the ones you're referring to, Senator, involve their interagency rules, and so they have to get the consent, the agreement of other agencies in order to implement, but have informed us that they are going about that process and are themselves ready to commit. If you're talking about recommendations of the supervisors about banks, that's a different issue.
I'm also interested in the open issues that are non-public. So could any of those non-public open issues have contributed to the Fed's failures in supervising SVB?
I don't believe so. What I believe is that our non-public open recommendations deal typically with IT security, sensitive access, IT, cyber security related matters, and that's why they're not public, not kind of supervisory recommendations that relate to SVB.
In 2021, your office found that the Fed had not established an effective enterprise risk management governance structure, and that a majority of members of the Senior Officer Committee disagreed that there were clear lines of responsibility and authority for risk management within the Fed. And I'll have you answer this question later because we've got a number of people that want to ask questions and I need to go vote. The question is, where is the Fed on implementing its own effective risk management program? You can choose to answer now, or I can follow up with you later.
I'd be happy to follow up with you later.
Perfect. Thank you very much. Madam Chairman, I yield back. Thank you so much.
Thank you, Senator Lummis. Senator Scott.
Thank you, and thank you for the opportunity to be here. And thank you, Mr. Bialik, thank you for being here. What year did you start the Fed?
2011.
All right. Between 8, 9, and 10, how many bank failures were there in the country? Do you know?
Between 8, 9,
2008,
and 10?
2009.
Oh, before I got there?
Yeah.
I can't give you an exact number, sir.
Once you got there, would you agree that if there's a bank failure, that the Federal Reserve probably has some responsibility?
If it's a bank that they supervise or regulate, sure.
So in 2008, 2009, 2010, there were banks that the Federal Reserve was responsible for that failed, right?
Yes.
So since you've been there, have you done any review of why those banks failed and any failures of the Federal Reserve?
My predecessor would have done those at the time.
But
sure.
you haven't done any since you got there.
We have done, but I think there was one MLR a bunch of years ago, but nothing significant and nothing recent.
How many banks that the Federal Reserve was responsible for have failed since you've been there?
I'm sorry, how many?
How many banks have failed since you've been there?
Less than a handful, I think.
Okay. So let's say 6, if you think that's the right number.
That would be a guess. I'd really want to look into it and get you an exact number. I don't want to mislead the committee.
So of those, let's say it's 6, how many reports have you done that anybody was fired because they failed to do their job?
I can't answer that question. I don't know.
Does that mean none?
I can't answer. I don't know.
Do you know of any?
I'm not aware of any, no.
Okay. So as far as you know, of bank failures, of any report that you've done, no one's been fired?
None that I have heard of.
Okay. So with regard to the stock disclosure, right, that there was the there's an accusation of insider trading. You've done some reports, but you haven't released that publicly yet, right? All of it.
Correct.
Has anyone been fired?
There are 2 matters that we've closed out. There are 3 matters that are still open, ongoing investigations.
Was anybody fired?
Not that I'm aware of. I don't know. I wouldn't necessarily know.
Okay. So why wouldn't you know?
Well, we provide our work and issue our reports, and
You don't follow up?
the 2 reports that we issued, or the 1 report that we issued on the 2 investigations that we closed out, didn't have findings of wrongdoing. So I wouldn't expect there to be the kinds of actions that you're referring to.
Okay. All right. So for the first, I've been up here 4 years. For the first time since I've been up here, with that unsolicited, a federal employee wrote me a letter. You wrote, Elizabeth, Senator Warren, and me a letter saying you disliked our idea of having a presidential appointed supervisor election, or a inspector general. All right. So that, first off, that surprised me. So first, did you tell Chairman Powell that you were doing this?
No, I did not.
Did he say anything to you after you did it?
No, he did not.
Did you talk to anybody at the Federal Reserve? You just did it completely on your own?
I did.
Okay. So you believe that you can adequately do your job when you report to the same people you're supposed to review?
Senator, as you may know, the concept of a DFEIG, Designated Federal Entity IG, of which I am one, there are about 30, almost half of the IG community, are IGs appointed by their agency heads. The others are the PAS, presidential appointees, subject to Senate confirmation. There are differences of view within the oversight community about whether the mere appointment authority of a DFEIG provides some question about their independence, because the person.
I mean, if Chairman Powell can fire you, you're going to go. Let me ask you a question. Have you done a review of any member of the Federal Reserve Board and ever said anybody on the Federal Reserve Board, anybody, has ever done anything wrong?
We have investigations going on all the time where we find wrongdoing. And if I can, Senator, we wind up deciding to do our investigations completely on our own without any input from anybody. Nobody has attempted to try to prevent us from doing any of our investigations. And the fact that the IG here can, along with all of the other DFE IGs, can be removed by their agency head is a part of the fabric of the community. Here at the Federal Reserve, there's an additional protection, if you will, if you believe this is a protection, that it isn't the Federal Reserve Board chair who can remove the IG. It's got to be based on a vote of 2/3, a supermajority of the entire
Can I ask you a
board.
question? Since you've been there, how many times has the chairman of the Federal Reserve proposed something at a board meeting and it didn't happen?
I can't answer that.
Yeah, probably not. So I ask one more question. So you suggested in there that you make $350,000 a year, and you suggested if we went back to the pay scale for the president-appointed inspector generals, we wouldn't get competent people. That's what you said in your letter. So does that mean that the inspector generals we have that are presidentially appointed, you don't think we're getting the competent people to do the job?
What I was referring to, Senator, in that letter was simply that the future, the eventual IG, should this position be converted into a PAS IG, would be making significantly less than the current arrangement is, and that puts them at a certain comparison vis-a-vis the rest of the Federal Reserve Board executive leadership, which the statute, the IG Act, set up as the appropriate pay scale for DFE IGs.
So if we get this legislation passed, all right, and the pay scale goes down to a little over 200,000, will you quit?
I honestly haven't made that choice or decision, haven't thought about it.
Okay. So, but just let me finish. No one, so think about it. There's 23,000 people, I think, that work at the Federal Reserve. There's not a report you've done since 2011 that you know of any person that's been fired. You don't remember, you don't have any, there's nobody at the Federal Reserve on the board that's ever done anything wrong. We don't have any information, good information on what happened on the stock trades. And you think that we should be happy that we don't have an independent, presidentially appointed inspector general? I mean, this doesn't make any sense. And it's got a balance sheet of $8.6 trillion, and in the last 12 months, the balance sheet, the Federal Reserve has lost $500 billion. I mean, name another agency that has that big a balance sheet in the federal government.
If I can clarify something, Senator, when you were asking about what happens as a result of our audits and evaluations and bank failures, that is what I said I couldn't cite for you numbers of folks who have been fired. I did also say we conduct investigations all the time, and there have been people fired as a result of our investigations. That's a separate workload for us.
Can you get me a report? I have not found one person. If you go back to the 2008 financial crisis and you go to what's happened this year, I've never heard of one person at the Federal Reserve that lost their job. Clearly, these banks did the wrong thing, but somebody at the Federal Reserve that was responsible for these banks for supervision clearly did it wrong. And guess who pays for it? The average person in America pays for all this. These bailouts are ridiculous, and we've been doing it for decades, and it should stop. Thank you.
Thank you, Senator Scott. So I recognize myself now for the first round of questions, and I want to say thank you for being here, Mr. Bialik. I appreciate your being here. The Fed touches the lives of nearly every family in America, from influencing whether or not they can afford to buy a home, keep a job, afford the interest rate on their credit cards, and know that the money in their checking accounts is safe. The Office of the Inspector General is essential to making sure that the Federal Reserve does its job with integrity. So the mission of the IG is to provide independent oversight of the activities of the Federal Reserve Chair and the board, including by, quote, conducting audits, investigations, and other reviews. So let's just set it up on the record here. We've talked some about it. Mr. Bialik, who appointed you as Fed IG?
Former Chairman Bernanke.
Okay. And who has the power to fire you?
A two-thirds vote of the present Board of Governors.
So it's the Board of Governors and the Fed Chair, right, together?
He's part of the board.
Okay. So your job is to conduct independent oversight of the Federal Reserve Board, exactly the board that has the power to hire and fire you.
As is the case with all DFEIGs.
Well, but that is yours. And, I noticed earlier that you said no one has ever tried to interfere with any of your investigations, but has there ever been a single day that you woke up not remembering exactly who has the power to fire you?
I don't think about that.
Yeah, I'm sure you don't. The inspectors general at nearly all of the cabinet-level agencies have a very different IG structure. Those IGs are nominated by the president and confirmed by the Senate, precisely so that they retain independence from the agency that they are obligated to oversee. They are not hired and fired by the head of the agency and a board within the agency. And that is why 20 years ago, the Government Accountability Office specifically recommended that Congress make the Fed IG a Senate-confirmed position. Now, I think it's long past time that Congress finally acts, and I have bipartisan legislation with Senator Scott to do that. This language is also included in a bill that I lead with Senator Tillis and Senator Lummis. But Mr. Bialik, you stated in a letter that you sent to Senator Scott and me a few weeks ago that you oppose this legislation. And in it, you raised concerns that Senator Scott just highlighted as well, that if the IG's office becomes a Senate-confirmed position, there will be, and I quote, difficulty in attracting quality candidates for the position because, among other things, the salary would have to follow the executive pay scale for all those other cabinet-level IGs, which would be about $200,000. So just so we get it on the record, how much is your salary, Mr. Bialik?
It is an average of the current division directors and other executives
I just
in
need a dollar
the
figure.
agency and their salary and bonus, and that comes out to $377,000. And $800 and some odd dollars.
Okay, so about $378,000 annually. You realize that makes you the highest paid employee at the Fed, and in fact, one of the highest paid officials in the entire federal government. And I understand why you wouldn't want to give that up. You know, this is a pretty cushy gig. You get paid a lot of money for it. But I don't believe that your self-interest should outweigh the importance of good governance and independent governance at the Fed. There has been one scandal after another at the Fed for the last 2 years, and these are a great example of why the Fed needs an independent watchdog to keep an eye on the agency. We need to fix the Fed Inspector General to make sure that the office is truly independent and can do its job. Senator Kennedy?
Thank you, Madam Chair. General, welcome. Help me. I tried to listen carefully to my colleagues, but I'm still a little bit confused. You've been IG since 2011, and you do a lot of internal investigations. In other words, did some particular employee at the Fed not do their job? Is that correct?
Yes.
About how many of those you think you've done?
Well, in terms of investigations of potential misconduct or wrongdoing, we have typically had a running average of about 60 or 70 of those. Obviously, the pandemic...
Is that total? 60 or 70 a year?
No, at any point in time.
Okay.
Many of them are closed. New ones come in through our hotline, which we open up, but that's typically a rough gauge for how many investigations we have pending.
Since you've been there in 2011, again, I'm talking internal investigations, would 500 sound right?
I'd have to look into it. I don't want to give you a number.
No, I'm not going to hold you to it. Wasn't many, is it more? You think it's more than 500?
I would like to look into it and get you an exact number.
Okay. In what percentage of the cases, just ballpark, do you find wrongdoing?
Again, it would be a wild guess, and I'm not comfortable giving one to you, but we can certainly look into that and develop those numbers for you.
Frankly, I would have thought would have that before you came today. We think it's more than half?
No, I would not think so.
More than a quarter?
That's where I'm uncomfortable.
Well, is it happen frequently that you find wrongdoing, or infrequently?
It's not infrequent.
It's not infrequent? Mm-hmm. Okay. All right. And when you find wrongdoing, are the people who committed the wrongdoing, according to your report, fired?
Sometimes.
Okay. What percentage are fired?
Again, sir, I would like to get you a specific number if that's what you'd like.
Yeah, I think if you could get us that number, and perhaps we could do this again. Because I think people have the right to know that. I don't want to pick on the Federal Reserve. I just want to treat them like everybody else. And my sense is, and I think your numbers can prove or disprove this, but my sense is that it is easier to divorce your spouse than get fired at the Federal Reserve. And if that's the case, we're entitled to know that. It's a lot of money over there. And that's not a criticism of anybody. And tell me again about your salary. It's the average of what?
It's the average of both the salary and the bonus that is attributed to the other individuals who are similarly situated in terms of the organizational structure, which for me is the division director level. So there are 12 other individuals, and it's the average of their salary plus bonus.
Okay. So there are about 13 of you, and and your salary is set on the average of the 13.
That is the case for all DFEIGs. That's in the IG Act as the formula to be
I'm
used.
just asking, are the others set that way too?
The other
The 12 other ones whose salaries are used to get your salary?
I'm not aware of how those are set,
Okay.
are established.
Okay. And do you get a bonus?
No, I do not.
Okay. Do the others get a bonus?
Yes, that's part of that average that I mentioned.
Okay. Do all 12 of the others get a bonus?
I don't know the answer to that.
Do they get a bonus when they say inflation is transitory and it's not? Do they still get their bonus?
I don't have the answer to that.
Okay. How do we get that information?
Requested from the Federal Reserve folks.
How about we call the IG? Can you get it for us?
IG should not be in the position of getting information to turn over if we're not otherwise engaged in an audit or evaluation or investigation.
I know you're in the, if I could have 30 more seconds. I know you're in the process of looking at the bank failures, and I don't want you to, I'm not trying to put you on the spot because you don't know yet, but you know, I find two things ironic. Maybe irony is the wrong word to use, but as a result of these well, strike that. It seems that ever since the Great Recession, we've been very concerned, as we should be, about banks that are too big to fail. Big is dangerous. I'm not against big. I'm against dumb. So, but if you have an institution that is really, really big and it does something dumb, it hurts a lot of people. Nobody ever goes to jail, but that's a separate story. But it looks to me like, as a result of these recent failures, that our big banks are getting bigger. And I find that ironic. Again, maybe the wrong word. I don't know if you're going to look at that in your studies.
Well, Senator, that strikes me as being a straight-ahead policy issue. The Federal Reserve Board decides what rules of engagement for the supervision of banks at different sizes, tailoring, and all of those are supervisory, policy-based decisions, and the IGs are prohibited from getting involved in overseeing policy.
Senator Warren and I may disagree with this, but we disagree a lot, but we still like each other. But see, if I ask Mr. Barr that question, I think the answer I'm going to get is, look, the problem with the bank failures is the management did dumb things, and they were incompetent. And yes, some of my regulators were not as proactive as they should have been, but it's Trump's fault. Trump ain't my homework. And I don't think that's a candid assessment of the situation. The other thing that I find curious, and I'm going to ask Mr. Barr about this. Traditionally, when banks get in trouble, you don't go out and shout it. You know, we're in trouble. They call their regulators, say, we got a problem here. Or the regulators spot it and they go in. And to prevent a bank run or panic, they handle it quietly. And the regulators will call around with other banks that are healthier and say, can we affect a marriage here? And that doesn't seem to be what's happening. And as a result, the healthy banks that would normally come in and help for a price, a fair price, and help the failed bank, the healthy banks, they're pretty smart. They're waiting. They're going, no, we don't want to come in too early. Let's let them go under. And then we'll come in and we'll get a great deal, and the taxpayers will have to guarantee all our potential losses. Can you look into that? Because if I ask Mr. Barr, God bless him, he's just going to say, it's the fault of the bank presidents and Trump ate my homework. So I'm looking for somebody who can help us answer those.
To the extent that you're asking, Senator, about the process of once a bank fails, what does the Fed, what does the FDIC do in terms of trying to get another bank to come in and take over or buy its operations? That would be kind of post-failure, so that wouldn't be part of our current review, material loss reviews, but we can consider looking into the kind of post-failure issues like that, or discussions that may have been had with the other financial regulators.
I'm taking too long, but here's what I'm getting to. And this is not a criticism of J.P. Morgan or Mr. Diamond. I have great respect for both of them. But you know the deal they made is a good deal. I'm not suggesting that they shouldn't have made a good deal for their shareholders. But the truth is, the deal was so good, if we still had white pages, you could open up the white pages, put your hand over your eyes, and pick a name and say, we're giving you this deal. And it would be successful. Because the taxpayers had to guarantee 80% of the losses. And somebody needs to look at that.
Senator, I'd be happy to come up and talk to you further about that, have my team come up and discuss it with you and your staff and see if there's a way.
But I want to talk about it in front of the American people.
Okay.
Okay?
Well, we can start by having a conversation in your office if you'd like. It's up to you.
Thank you, sir.
Thank you, Senator Kennedy. Senator Kennedy, I want to follow up on something you did. I have another round of questions I want to do. But we're talking about this compensation issue. And the reason we're talking about compensation is just basic conflicts of interest. It's very hard to oversee somebody who can fire you. It's very hard to point out that this is the person who engaged in wrongdoing if that's somebody who can turn around and fire you. But I want to raise a second point that came out in the question about how your compensation is calculated. I believe you said your compensation is the average of the other people whom you investigate, and it's their salaries plus their bonuses. So if your investigation finds they did really bad and stupid things that caused them not to get bonuses, what happens to your compensation?
If there is a reduction in one of those individuals' bonuses.
So you make less money
that's correct.
if you find wrongdoing in the people you oversee. Do you think that creates conflict of interest?
I don't, honestly, because I have been in the IG community for over 42 years. I'm not in this business to do anything but make sure that we properly, the 130 folks who work in the Office of Inspector General, properly oversee the work, the efficiencies of the Fed. And if we find improvements that need to be made, it's our job to point them out. It doesn't matter to me one bit.
Mr. Bailey, it's easy for you to say, it doesn't matter to me one bit how much I get paid, but you have to understand there are a lot of people around the country who look at a $378,000 salary that is one of the highest salaries in the Fed and one of the highest salaries in the federal government, and says if your salary goes up, if you give everybody a gold star, and it goes down if you find a problem, and not see that as a structural conflict of interest. It doesn't have to be personal. It doesn't have to be to say that you are a bad person. It just says that we should not have both of those occurring in the same place. The person who is responsible for handing out the gold stars on whatever happened or handing out the you did a bad job should not have a direct financial stake in how that comes out.
I understand your point, Senator. My only other comment would be that provision of the IG Act that sets up those two different pay systems for IGs, the PAS IG and the DFE IGs, that was put into place in 1988 by Congress. There have been amendments to the IG Act since then, and that issue hasn't been changed, but that's up to Congress to decide.
20 years ago, the GAO came to Congress, long before I was here, long before Senator Kennedy was here, and said, change it, because it's a mistake. They said, change it so that you have an independent IG at the Fed, and I think this is the reason why. So if I can, what I want to do is I want to talk about the ethics scandal while we still have you here. And that is in September 2021, reports revealed a shocking ethics scandal at the Fed. Fed leadership at both the reserve banks and the Board of Governors had made stock and other financial trades at the same time that the Fed was taking extraordinary action to stabilize the economy during the COVID-19 pandemic. For example, former Fed Vice Chair Richard Clarida cashed out somewhere between $1 million and $5 million from a bond fund and put the money into stock funds exactly one day before Chair Powell publicly announced possible policy action that would significantly affect the value of those bonds and stocks. Now, make no mistake, this is the most severe ethics scandal in the Fed's 110-year history. Yet, other than a few officials taking an early retirement, we have seen no accountability, not from Chair Powell and not from the Fed's Inspector General. That's you, Mr. Bialy. So, Mr. Bialy, you conducted an investigation of Fed officials' stock trades at Fed Chair Powell's request. Here we are, a year and a half later, and I believe we are still waiting for the results of your investigation into the Reserve Bank presidents. But last year, you did release a 4-page report about your investigation of key Fed board members. And in that investigation, you found that former Vice Chair Clarida failed to report several trades in 2019 and 2020. Am I right so far?
Yes.
Okay. So you also found that trades involving Chair Powell's family trust were made during a blackout period for the Federal Open Market Committee, the Fed's monetary policy-making body, trades that should not have been made at those times under the Fed's rules, correct?
Yes.
Okay. So the rules say no trading during the blackout period, but Powell's Trust did exactly that. The rules say Fed governors must disclose all trades in a timely fashion. Mr. Clarida clearly did not. And yet your investigation, I'm going to quote you here, quote, did not find evidence that your boss, Chair Powell, and Mr. Clarida violated the Fed's rules. That finding just makes no sense to me. The actions of the chair of the Federal Reserve and a governor of the Federal Reserve were unambiguously inconsistent with the Fed's rules. You just said so, but you recommended no disciplinary action, no corrective action. Now, in addition to your conclusion that flies directly in the face of the facts, I also have concerns about what you left out of your investigation. According to his financial disclosures, Chair Powell sold between $1 and $5 million worth of stock at the start of October 2020, reportedly one of his largest trades ever, just as the stock market was beginning to tank. This is suspicious timing, but you did not look into this trade as part of your investigation. Why not?
If I can elaborate a bit more on this series of questions or issues that you've raised, Senator.
Okay, can you just answer this question, though, first, so I don't get confused here? Why did you not investigate this trade? It's not in your report.
We investigated all trades made by both former Vice Chair Clarida and Chair Powell. We looked at each and every one of those trades. We reviewed the source documentation for those trades. We got into a level of...
So you're telling me these trades did not occur?
No, I'm going to tell you that as it relates to Vice Chair Clarida, those 4 trades that were made that were not initially included on his 2019 and 2020 financial disclosure reports were left out. The resolution of that, we have to audit and investigate against criteria. The criteria is, yes, they should have been included, and they weren't.
Then how could you say there was no evidence that anyone violated the rules? It clearly violated the rules.
The Office of Government Ethics, this is their form, the government ethics program throughout the executive branch is monitored by and set up by the Office of Government Ethics. Their approach is if someone leaves something out of a report, assuming, as is the case here, that the trades were not prohibited trades and they were not made during official blackout periods, that the resolution is to include those on the subsequent report, to make it a complete report for the next year. What Vice Chair Clarida did is he went ahead and amended those forms from 2019 and 2020. So he did more than what the Office of Government Ethics would have advised him to do.
So when I asked you the questions, do they violate the rules? You say, yes, they violate the rules, but it turns out if you fix it later, you don't count that as violating the rules.
That, according to the
Okay.
Office of Government Ethics,
and what was the
that's
answer?
the case. And if I can, on Chair Powell's charitable family trust that you mentioned, that is a matter where the financial advisors who handled that family trust, that charitable family trust for them, was notified of the blackout dates for the FOMC blackout period. They were asked to make, as they are every year towards the end of the year, to sell some assets so that the family trust can carry out its requirement to make charitable donations at that time of year. They admitted that it was their oversight that they did the transaction a day or two after the blackout period began. The request was made before that. And it was their kind of error, their mistake that allowed that to happen. There has to be kind of an intent to misreport.
Look, we can get into the intent questions, you know, particularly when you're telling me about Clarita, for example, corrected this later. Yeah, he corrected it after you opened an investigation, which is just not exactly the moment that gives us all confidence. But I still didn't hear the answer to the question about that I asked you here. Chair Powell sold between $1 and $5 million worth of stock at the beginning of October 2020, one of his largest trades ever. Suspicious timing, but you did not look into the trade as part of your investigation. I just want to understand why.
We did look into that trade. The trade was not prohibited, nor was it made during the blackout period. If I can add, I acknowledge that our investigative report lacks the kind of detailed analysis that would kind of close these perceived gaps that you're alluding to, Senator, but it was intentional while we pursue these other closely related and ongoing ethics investigations of the Federal Reserve Bank officials.
So
I absolutely agree that the allegations of improper trading and ethics violations are disturbing, and they are alarming. I agree with you wholeheartedly, but we have to conduct a thorough, independent investigation.
You have had a year and a half.
And we
You
cannot...
did not call out the trades that we can see. Let us just put it this way. This is not strong oversight. In fact, it is not even competent oversight. It looks like, to anyone in the public, that you gave your boss a free pass. And that's just not going to cut it here. And even today, a year and a half later, the Fed continues to stonewall Congress, stonewall the public on the underlying information about these trades. This is not acceptable, and this is why we are pushing for an independent IG. I understand we're going to have to go vote. Is that right? All right, we're being called to vote. If I can, I'm going to excuse this panel. I'm going to ask the next panel to come up. We will vote, and we will be back as fast as our feet will carry us. Fair enough?
Fair enough.
Thank you. We're in recess. This hearing is called back to order. Now I will introduce our witnesses. First, I am pleased to introduce Dr. Peter Conti Brown, the class of 1965 Associate Professor of Financial Regulation and co-director of the Wharton Initiative of Financial Policy and Regulation at the Wharton School of the University of Pennsylvania. Dr. Conti Brown is one of the foremost experts on the history of the Fed and of financial regulation. Thank you for being here with us, Dr. Conti Brown. Next, we have Dr. Paul Kupiak. Am I saying that right? Kupiak? Good. Kupiak, an economist and senior fellow at the American Enterprise Institute. Dr. Kupiak has decades of experience working on financial regulatory issues, including while working at the Fed and at the FDIC. Thank you for being here, Dr. Kupiak. And finally, we have Ms. Mayra Rodriguez Vallajardes. Good. Managing Director of MRV Associates. Ms. Rodriguez Vallajardes has 30 years of experience consulting and training professionals at banks and financial regulatory agencies in over 30 countries, helping to implement financial regulations on the ground. Thank you, Ms. Rodriguez Vallajardes. I appreciate all of our witnesses being here today, and if I can, I would recognize Dr. Peter Conti Brown for an opening statement. You're recognized for 5 minutes.
Thank you, Chair Warren, Ranking Member Kennedy, members of the subcommittee. It's a privilege to testify before you today. Over the past 2 months, 3 of the roughly 20 banks with assets between $100 billion and $250 billion have failed. Of the remaining 17, we do not know how many would have failed but for the extraordinary intervention of the government related to the other 3. Since March 12, 2023, we have been in a roiling banking crisis, a fact acknowledged by the very interventions that the Fed, Treasury, and FDIC have made to prevent this crisis from spiraling into a financial cataclysm. It is said that failure is an orphan where victory has many parents, but I would say this failure has many parents indeed. The primary responsibility relies, of course, with the bankers that mismanage these risks so catastrophically. But failures of so much of this market segment also invite important questions. The extraordinary powers used over the last 2 months were designed or redesigned after the 2008 financial crisis, especially through Congress's passage of the 2010 Dodd-Frank Act. At the time, it was the hope of Congress, the President, and the American people that such unusual and extraordinary government interventions would be rare. Rare because individual bank failures would be preventable through robust regulation and supervision, and rare because even if unprevented, an individual bank's failure would not a systemic crisis make. March 12th was a referendum on those hopes, and those hopes were dashed. The questions we must ask ourselves, among many others, then, are these. First, what did we fail to do in the years leading up to March 2023? Second, what changes does this crisis invite us to ponder that can strengthen us against future crises? And last, what changes must we make to restore the confidence of the American people in our government's ability to ensure that our financial system stays robust, resilient, and just for all members of our society, and not only the wealthiest among us? In my written testimony today, I address each of these questions in depth. In this opening statement, I'll merely state my conclusions. More specifically, I have 3. First, the actions taken by Congress through the passage of the Economic Growth, Regulatory Relief, and Consumer Protection Act of 2018, and through additional regulatory pullback of supervisory discretion thereafter, created a climate where grumpy banks could ignore supervisory warnings to get their house in order with impunity. We're still learning more of these details, most of which remain bound and gagged behind walls of confidential supervisory information. But so far, we can surmise that the bankers either roughed up the refs or ran out the clock, forcing the rest of us to lose a game that we might have won. The law passed in 2018 is a key part of this story, despite the fact that the law itself did not contain a binding mandate for these supervisors and regulators to exit the field. Bank supervision and its relationship to Congress simply does not work that way. It depends instead on instructions from legislators and regulators to guide the practice of this hyper-secret, highly discretionary, and extremely potent form of government oversight. When you hear then that the failure of these banks was a failure of banker risk management and then in turn a failure of bank supervision, you hear truths, but only partial truths. In our democratic system, bank supervisors, toiling in secrecy though they may be, must still answer to the people through regulators appointed by presidents and legislators elected by the people themselves. In 2018 and beyond, the answer from Congress and regulators could not have been clearer. Supervisors were to pull back. My second conclusion is that we must reform the way information is collected from and accountability provided over the Federal Reserve System. Our nation's central bank has a rich history of superb public service, including in the present day, but the individual and collective expertise within the Fed does not render these public servants superhuman. When the Fed faces a scandal or a crisis, as it has done many times in its recent history, we simply cannot depend upon it to understand it itself and report to the rest of us its new enlightened sensibilities. Fed Chair Jerome Powell and Vice Chair for Supervision Michael Barr have emphasized that they welcome independent review of the Fed's actions. But I would go further. Such independent review should not be merely welcome. It must be vital. To that end, I support rendering the Inspector General of the Federal Reserve System, currently answerable only to the Fed itself, to a presidential appointment subject to Senate confirmation. The Federal Reserve must not seem and must not be supervised by itself. Finally, and most briefly, as my time is expiring, the Federal Reserve System as designed in 1913 needs an overhaul. At the time, subject to the politics of the day that barely made sense for the Woodrow Wilson administration, it was deemed expedient to create not one, but 12 central banks with private bankers governing their central bankers. It is past time for us to remove private bankers from this public role, or at least consider alterations to their presence. The appearance and fact of conflict of interest is something that we, the people, should not abide. I look forward to your questions.
Thank you, Dr. Conti Brown. Dr. Kupiec.
Chair Warren, Ranking Member Kennedy, and subcommittee members, thank you for the opportunity to testify today. The precarious nature of SVB's financial condition was obvious from regulatory call report information. As I demonstrate in detail in my written testimony, there was no need to know anything about SVB's internal liquidity stress test, the results of a Federal Reserve Board or internal bank stress test, or the results of any other complex model-derived regulation to see that, by early March 2023, SVB was likely insolvent on a mark-to-market basis and in danger of experiencing a serious depositor run should its uninsured depositors recognize the bank's true condition. SVB was essentially run like a money market mutual fund without the safety benefit of SEC regulations that would have restricted the duration of its investments. SVB funded itself by attracting large uninsured deposits during a period when short-term interest rates on these accounts were close to zero. 97.5% of SVB's deposits were uninsured, and most of these were in money market deposit accounts. SVB invested its deposits in longer maturity securities and loans to earn yield. Most of SVB's securities had a federal government guarantee and hence low or zero regulatory capital risk weights. Examiners did not criticize these investments. Examiners actually gave SVB a good camel's liquidity rating because it owned these long-term securities. It should have been obvious to bank examiners that SVB's business model was unsustainable in a climate of rising short-term interest rates, but there are no examiner findings to this effect. SVB's failed even though it satisfied all the complex rules in place that determine its required regulatory capital. The passage of S-2155 had nothing to do with the failure of SVB. S-2155's tailoring requirements apply to Dodd-Frank enhanced regulation for large bank holding companies. In SVB's case, the risks were obvious, and they were in SVB Bank, not in SVB's holding company. Federal banking regulators have ample power under prompt corrective action legislation to remedy any serious safety and soundness issue examiners identify in a bank like SVB. Timely and proper exercise of the Fed's prompt corrective action powers could have been used to de-risk SVB, but they weren't. Virtually all of the corrected supervisory recommendations made to SVB concerned processes associated with SVB's model-based large bank regulations and other bank procedures required to measure and monitor SVB's risks. None of the corrective actions spoke to the actual liquidity risk associated with SVB's funding mix, the financial ramifications of its interest rate risk profile, or the bank's true capital adequacy risk. The failure of the Federal Reserve examination team to appreciate the impact of rising short-term interest rates on the market value of SVB's held-to-maturity securities is shocking, given that this data is reported in SVB's quarterly regulatory recall reports. And the Federal Reserve itself experienced a huge $1 trillion unrealized market value loss on its own held-to-securities portfolio. Meanwhile, senior Federal Reserve Board and U.S. Treasury officials were declaring the banking system to be safe, well capitalized, even as FDIC analysts and academics pointed to massive unrecognized banking system losses. Assessments made by the Federal Reserve Board and FSOC's official financial stability reports were less than prescient, as they ignored the role monetary policy played in generating the risks that destabilized the banking system. The FDIC also played a role. SVB is an example of a situation for which the FDIC's backup exam authority was designed. No report suggests that the FDIC pushed back on the Fed's lack of zeal in enforcing prompt corrective actions, even though the FDIC's early warning models should have flagged SVB as a failure risk. It is highly unlikely that the FDIC's large bank deposit insurance premium assessment charged SVB Bank anywhere near an appropriate deposit insurance premium. The system does not appear to emphasize the risk that caused SVB to fail. Proper deposit insurance pricing could have changed the way SVB invested its deposits. In the little time I have remaining, I want to go through some possibilities that might help stem such incidents in the future. Adopting the GAO recommendation to revisit prompt corrective action rules to add explicit non-regulatory capital triggers that would mandate remedial examiner actions. Regulatory capital requirements do not account for interest rate risk. Bank supervisors are, however, regularly appraised of the unrealized losses on banks' held-to-maturity securities and should recognize those losses when assessing an institution's capital adequacy. Large bank and holding company regulations have become exceedingly complex with a heavy reliance on economic modeling and hypothetical simulation exercises. The SVB supervisory experience suggests that overemphasis on models and processes may cause examiners to lose focus on important fundamental bank risks. The power of the Federal Reserve Board, FDIC, and Secretary of the Treasury to declare a systemic risk exception and release the FDIC from its least cost resolution mandate is not constrained by any checks and balances in legislation. There should be an accountability structure in place to guide the choice of policy taken once a systemic risk exception is declared. Since the Dodd-Frank Act, systemic risk has become the reason for expanding Federal Reserve regulatory powers. However, the term systemic risk is never defined in the Dodd-Frank Act. This legal ambiguity has made the FSOC a political tool rather than an independent voice on actual risks that threaten financial stability. The FDIC's risk-based deposit insurance premium rules for large banks need to be revisited, and recent events demonstrate the need to improve Federal Reserve oversight and accountability. A Senate-confirmed IG may help. District Federal Reserve Banks should be subject to FOIA laws, and Congress should allocate additional resources to its committees dedicated to Federal Reserve oversight. Thank you very much.
Thank you, Dr. Kupiec. Ms. Rodriguez-Vallardes.
Thank you. Chair Warren, Ranking Member Kennedy, and distinguished members of the Subcommittee on Economic Policy, thank you for the opportunity to appear before you. I am Mayra Rodriguez-Valladares, Managing Principal of MRV Associates. My testimony today is based on my professional experience of 3 decades consulting and training professionals at banks and financial regulatory agencies in over 30 countries on a wide range of risks that can threaten financial institutions' safety and soundness. Laws about banks are incredibly important. They lead bank regulators to define the type of rules they write, promote supervisory culture at the top, and design examination processes. The Economic Growth, Regulatory Relief, and Consumer Protection Act greatly influenced former Vice Chair of the Federal Reserve, Randall Quarles, to propose the tailoring rules. He said, "The Congress wants to see action and has, to a certain degree, specified some of the steps we need to take," end quote. He also stated that in conjunction with changing regulations, we also need to consider how those regulations would be reflected in supervisory programs, guidance, and regulatory reporting. Prompt corrective action is not enough when you have that type of supervisory culture. Throughout 2017 and 2018, almost 400 financial institutions lobbied heavily in favor of EGRCPA. Former Silicon Valley Bank CEO Greg Becker and many bank lobbyists and politicians were also in favor of EGRCCPA and argued that regional banks did not pose risks to the financial system. Barely 5 years later, those words did not age well. I do not have schadenfreude when I remember that in August 2018, I wrote, "Taxpayers should not be fooled into thinking that banks that are in the asset range of 100 to 250 billion are not systemically important, because regional and foreign bank organizations of that size are incredibly interconnected to other financial institutions and to thousands of companies in the U.S. due to the loans that they extend and the financial derivatives that they arrange for companies of every size. If any of those banks were to run into problems for being insufficiently capitalized, or if they were to become illiquid, taxpayers would suffer the consequences." After conducting the financial sector assessment process of the United States in 2020, independent analysts and consultants hired by the International Monetary Fund were critical about the shortcomings of S2155, EGRCPA, as well as of the Federal Reserve's tailoring approach. The IMF recommended that U.S. regulators introduce rules on concentration risk management and include more quantitative standards on interest rate risk in the banking book, as well as making specific capital and liquidity recommendations for large banks that were not internationally active. In other words, our regional banks. After analyzing all the CAMEL's examination reports, capital, asset quality, management, earnings, and liquidity standards, and sensitivity to market risk, and the supervisory letters released by the Federal Reserve, I know that Silicon Valley Bank CEO Greg Becker, his colleagues, and board willingly ignored the numerous interest rate, liquidity, Bank Secrecy Act, anti-money laundering, compliance failures, data problems, information technology weaknesses, and incredibly ineffective internal audit and credit risk management processes, some of those going back all the way to 2016. All the aforementioned were identified by California and Federal Reserve Bank of San Francisco examiners. Additionally, SVB did not disclose important interest rate risk measurements such as economic value of equity in its annual report or Basel III Pillar 3 risk disclosures, leaving the market in the dark. The problem, however, is that there is still so much that we do not know about SVB's failure because an independent postmortem has not been completed. Who at regulatory agencies ignored examiners' findings year after year, and why? I respectfully recommend the following legislative and supervisory process changes that I detailed more in my written statement. 1, order an independent investigation of the Silicon Valley Bank failure. 2, appoint an independent inspector general for the Federal Reserve based on a Senate confirmation. 3, revise Title IV of 2155 to reinstate Dodd-Frank's designation of systemically important banks. 4, remove heads of banks from Federal Reserve district boards. 5, reform remuneration for CEOs and key bank professionals. 6, require transparency from banks about their assets and liabilities and interest rate and liquidity risk managers more often than just once a quarter. 7, utilize all of the Federal Reserve's existing powers to escalate identified risk at banks and impose enforcement actions on non-compliant banks. 8, require improvements in the monitoring of banks' interest rate risk models. 9, reinstate the liquidity standard for all large bank organizations. And 10, provide strong protections for on-site examiners and off-site supervisors so that they can actually move things up the chain. Thank you very much, and I look forward to your questions.
Thank you very much. I really appreciate it, Ms. Rodriguez-Vallardes. I appreciate all of your testimony. This is really important and thoughtful. If we can, I'd like to dive deeper into some of the findings in the Fed's postmortem of the Silicon Valley Bank's collapse. The report made clear that the Fed failed at every step along the way, from the Board of Governors at the very top to the San Francisco Fed bank examiners on the ground, who were unwilling or unable to force SVB to fix its problems before the bank blew up. So let's start at the top with the Board of Governors. This is the body where bank rules are written and then communicated down to the reserve banks to enforce. One of the 4 causes of SVB's failure that the Fed report identifies is the 2018 law that Republicans, with the help from some Democrats, passed. This law severely weakened the guardrails that Congress put in place after the 2008 financial crisis to ensure that greedy banks never again crash the economy. That was certainly the intent. Dr. Conti Brown, you are an expert on financial regulation in the Fed. According to the Fed's Vice Chair Barr's report, how did the passage of that law, let's just call it 2155, that's what we call it around here, how did the passage of 2155, this bill that Congress voted on, lead to SVB's failure?
Thank you, Senator Warren. The provision in 2155 that refers to changing the asset classes is only about 5 pages long. It's very short. And it doesn't contain a mandate, Fed, thou shalt not supervise these banks. What it does is create a system that was in place under Dodd-Frank that for a bank to grow above 50 billion or above 100 billion, they knew that there would be significant regulatory and supervisory costs. Those costs went away because what Congress did is say anything below $250 billion is wiped clean. If you want to put it back, you got to go through a process. That's what they said to the Fed. And so for Silicon Valley Bank, which was hovering right below 50 billion at the time, that was just a massive neon light saying, grow, grow, grow. So that was one way. And when they grew so fast, so far on both liabilities and on assets, they couldn't diversify. And so that led to flighty deposits that rendered them sensitive on the funding side. And it led to undiversified assets, which led to their collapse in this interest rate environment. The other thing that it did is send a very pointed direction. And as a historian of bank supervision, I'm currently writing a 600-page history of bank supervision that I'm nearly completing. I can tell you this is exactly the way Congress works. It writes laws, and it says, this is the way we want you to use the tools, even when it doesn't say, thou shalt or thou shalt not. And that's exactly the way that Title IV of the law is written. It's to say, pull back on this regulation and give a green light for massive and undiversified growth.
So the Fed report says that Congress told the Fed to deregulate, and that's what you're saying. This is the message that was delivered. The Fed heard that message loud and clear, and then it used that message to open up and start to deregulate even further throughout the Fed system here. And the result, according to the report, is that S2155 and the Fed's tailoring that it took in response, quote, this is from the Barr report, impeded effective supervision by reducing standards, increasing complexity, and promoting a less assertive supervisory approach. And I think that's consistent with your testimony. Is that right, Dr. Connie Brown?
Yeah, it is.
Okay. So let me just then come over. Ms. Rodriguez-Valladares, you have decades of experience working as a bank examiner and training bank examiners. You're the one down on the ground with these folks who are making the calls with the banks every day. Do you agree with Vice Chair Barr's conclusion that S2155 promoted a less assertive supervisory approach?
Yes, very much so. And former Vice Chair Randall Quarles made it very clear before the American Bankers Association in the quote that I read that he really saw that Congress wanted these specific steps, and all of that is part of how, starting at the top, that tone, and filters all the way down to the different kinds of supervisors and examiners. And the tailoring rules meant that Silicon Valley Bank, for example, did not have to do a lot of incredibly important things, like really measure from a market perspective interest rate risks in the banking book, for example. It didn't have to do stressed liquidity coverage ratios. And so because it didn't have to do them, it didn't have to report them to the regulators or to the market. And that's incredibly important because if the regulators miss it, but it then comes out in an annual report or Pillar 3, then the market can discipline the banks. And all of that, unfortunately, was missing precisely because of those tailoring rules.
So the loosening ends up having multiplier effects, that once you loosen a little bit, you lose other discipline in the system. Is that a fair way to describe what you just
Yes,
said?
absolutely. And not only that, but then all of the appointees at the Fed, at the FDIC, and the OCC as well, obviously, that was a totally different tone. When I used to go to banks right after Dodd-Frank was signed, I would see the bankers with all of the different compliance, all the rules earmarked. They took them seriously. So did the bank examiners. And that, after 2018, really disappeared. The tone changed.
Okay, so the tone changed. And here's another piece of it I want to look at. You know, not only did the Fed use the political cover that Congress gave it and moved in the direction of weakening the rules for big banks even further, the Fed itself was lobbying for the bill to weaken regulations the whole time. Fed Chair Powell testified in favor of it. And according to press reports, the Fed's general counsel may actually have even drafted it. Now, the members of Congress who voted for S-2155 and the banking industry that lobbied for it now argue that the Fed had the discretion to continue to apply stronger rules to banks like SVB. They just chose not to. And I agree. The Fed should have used its authority to apply stronger rules to banks with more than $100 billion in assets. And that is why I called on Fed Vice Chair Barr to use that authority immediately now, and I'm glad that he has committed to do that. But you don't get to write a law that shoves the Fed in a strictly deregulatory direction and then turn around and say, gee, we wish they hadn't deregulated. Dr. Connie Brown, do you think that the big banks and the people calling on the Fed to deregulate would have supported the Fed's decision? Take yourself back to 2018. Would they have supported the Fed's decision to use its discretion to strengthen rules for the banks with more than $100 billion in assets if they had decided to do that once 2155 had been passed?
It's inconceivable that they would have supported a move such as that. And I would go further still. In the 20th century, the 110 years that the Fed has been in existence, unlike, say, the SEC or the EPA, regulated entities under the Fed rarely, if ever, sue it.
Yep.
And that is for a lot of complex reasons. Bank supervision is related to it. This is a counterfactual, but I'd bet my eye teeth that we would have seen some very significant litigation. And the reason I think that is because Title IV is written in a way consistent with D.C. Circuit legal doctrine to invite litigation. And the reason is because it contains like a 7-part test that if you want to tread into the 100 and 250 billion range, you're entitled to do so, but you have to consider all of the following. And we have seen after the financial crisis with the SEC, similar kinds of language struck down by the courts. And so I think that the banks subject in this counterfactual to that kind of a regulation would have not called their bank examiners for a conversation. They would have called their lawyers to launch litigation.
Wow. That's a really powerful point about this. You know, S-2155 weakened the rules and the supervision for these banks like SVB and opened the deregulatory door for the Fed to drive a truck through, which under Chair Powell, it immediately did. The change in the law and the tailoring the Fed pursued in response to that change, quote, combined to create a weaker regulatory framework for a firm like SVB. And that is according to the Fed's own report. So, look, I am very glad that Vice Chair Barr has committed to using his existing authority to strengthen those rules for big banks. But Congress needs to close that door for good. And that is why I've introduced a bill to repeal Title IV of S-2155, which would undo the Fed's deregulation of the biggest banks and ensure that we apply tougher rules to banks like SVB that have the power to threaten our banking system. Now, ordinarily at this moment, I would turn this over to my Republican counterpart for questions, but since he's not here, I'm going to go to my next round of questions on this. I want to focus on the other part of the Federal Reserve System, and that is the regional banks. Unlike the Board of Governors here in Washington, which is a public body with governors nominated by the President and confirmed by the Senate, the 12 reserve banks are private corporations overseen by private citizens, including a lot of bankers. Even so, these private reserve banks are permitted to play a crucially important role in public policy, including voting on interest rates and supervising banks. In the case of Silicon Valley Bank, the San Francisco Fed was the regulator on the ground responsible for ensuring that SVB was managing its risk. But the San Francisco Fed clearly failed to do so. By the time SVB collapsed, it had 31 unresolved supervisory issues, triple the number of warnings that similar banks had, which was already too big. It is great that the San Francisco Fed sent those warnings, but what's the point of sending warnings if there's no follow-up? Do you think no one is paying attention? Why didn't the San Francisco Fed force SVB to address the problems that the San Francisco Fed had already identified? Not they needed to figure out some other stuff, the stuff they clearly knew. So Dr. Connie Brown, I know that you have written a lot about the reserve banks, so let me just ask you for a little background here. Let's get this on the record. Who are these private citizens who oversee the 12 reserve banks?
Well, they hold an extremely important public trust, but they're not public officials. There are 9 of them total for each reserve bank, but there are reserve bank branches that consist of other boards that serve in a similar kind of role. For the reserve banks, these 9 are divided into 3 classes, classes A, B, and C. Class A are the bankers themselves. They are folks like Greg Becker, who was the president of SVB, who one minute would be sitting on the boardroom at SVB, and then I'd look at his watch and run over to the San Francisco Fed, so I've got another board meeting to go to. The next 3 are non-bankers, or at least not currently bankers, but they're also appointed by the bankers, supervised by the Fed. And Class C are to represent the public. They're appointed by the Board of Governors. Historically, all 9 of them were either recent bankers, current bankers, or distant bankers. Class C in the last 15 years or so has been better diversified.
So let me just get this straight. 2/3 of the people that oversee each of the reserve banks and handpick the leadership are elected by the very same banks that are regulated by the Reserve Bank. And 3 of those people actually work at the bank, right? That's how this works.
That's right. Dodd-Frank
Because
did.
people wouldn't believe this, you realize.
No. People think it's you're sending up quackers conspiracy theories when you tell this. It's written in the Federal Reserve Act. And one change that was made by Congress in 2010 is that the Class A directors, these are the bankers who are currently working as bankers, can no longer vote on the appointment of the Reserve Bank president. But we don't know what they can say about it. And I've talked to some people who say, oh, no, it's a very strict wall of separation. And others say, oh, they're constantly participating in these same kinds of discussions. As with nearly everything about Reserve Bank governance, the public has no idea.
Right. Okay, so this chummy little group is making a lot of policy here, and nobody else gets to see it. And you mentioned that one of the directors at the San Francisco Fed was Greg Becker, who at that very moment was also CEO of SVB. In fact, Mr. Becker, I just want to draw the line, was a director overseeing the regulator that was supposed to oversee Mr. Becker's bank. And this is exactly at the time that SVB received 54 supervisory warnings from the San Francisco Fed bank examiners, and the bank examiners, surprise, surprise, made no follow-up to force SVB to change any of its practices. So, Ms. Rodriguez-Valladares, Does the fact that the CEO of SVB was on the board overseeing the San Francisco Fed, SVB's regulator, raise questions for you about whether or not his presence on the board could have affected the strength of the San Francisco Fed's supervision?
Absolutely. He never should have been there, and it is something that is of great concern. He himself, yesterday, when he testified, mentioned that he frequently met with the president of the San Francisco Fed at least once a month, sometimes more frequently. And it's very, very difficult for examiners or anybody else at any of the district feds to say anything that is going to be critical of one of the board members. That kind of mechanism doesn't exist, and it's unfortunate that there still hasn't been a complete independent investigation of the SVB failure, because there's a lot of documents that we're missing. Normally, what happens, you examine a bank and you write about your findings and you submit your notes, you submit all of your documentation to what's called an EIC, the examiner in charge, and then he or she will review it, and then there's various other layers of middle management at the district feds that will look at those reports. So we, the public, have not seen, wait a minute, those risks were identified at SVB year after year, but what kind of middle management or anybody else got involved in the writing of the report? Also, in a little footnote in the CAMEL's examination reports, it says that the person who wrote the report was chosen by the Board of Governors. And so what then is exactly the relationship of the Board of Governors and the San Francisco Fed in this specific examination? So those details are very important.
So it sounds like to me that this is clearly a case of the fox guarding the hen house, and all the way through the system here. I want to note, this is not the first time. It's not like we pull back the curtain and are shocked to discover this happening in 2023. Back in 2008, JP Morgan's CEO, Jamie Dimon, was sitting on the New York Fed board at exactly the same time that his bank was borrowing emergency funds from the Fed. And who was the chairman of the New York Fed board at the time? It was the former head of Goldman Sachs, who was serving on the Goldman Sachs board at the same time, even as Goldman Sachs was borrowing billions of dollars from the Fed. And of course, all this happened at the same time that the Fed banks were recommending to Congress to do a huge bailout for the giant banks. So this has obviously been going on for a long time. Now, after 2008, Congress took steps to address these gross conflicts of interest at the Reserve Bank boards, but clearly we've still got a long way to go on this, and this is why Senator Rick Scott and I introduced a bipartisan bill today that would prohibit big bankers from serving as Reserve Bank directors. It would also subject directors to ethics and financial conflict of interest rules. It would foreclose any opportunity for directors to interfere with the supervisory process. You know, Dr. Kupiec, I'm afraid you're not going to get in on this, so if I can, I'll just turn to you and ask you, do you think if some of the legislation, like the kind that Senator Scott and I have proposed, I don't know if you've had a chance to see it in any detail, but would it help some with these conflicts of interest?
I have not read the legislation, but I would
I'm
point.
sorry, I didn't mean to cold call you on that.
No. Well, I looked a little bit at the IG, which I think is a good idea, but I would point out that the other two banks that failed are not part of the Federal Reserve System, and Signature Bank had Barney Frank on its board of directors, and Alphonse D'Amato, a former senator, the head of the banking committee, on its board of directors too. So there's a lot of blame to go around. So and that's not to say Mr. Becker it gets off the hook, but there are prominent connected people on
We've got a
boards
lot
of
of
directors.
conflicts, I think, is what you're
on
saying.
lots of
Dr.
boards of
Kupiec.
directors.
Is that a fair statement? We got a lot of conflicts
Yeah.
here. Well, let me ask you, Dr. Connie Brown, would these reforms that Senator Scott and I have proposed help address conflicts of interest in the reserve banks and maybe strengthen a little public confidence in the supervisory powers of these banks?
My only reaction is to take the maybe out of that sentence. I think that it is almost circular to say that this would help with the conflicts. And I just want you I just want to be clear, this is a moderate position. I would go much further. I would fire bankers from these boards entirely. And I recognize that there are politics here and there are interests involved. And so I think that the proposal from you and Senator Scott, which I have reviewed, does not go as far as I would like, but it does help to manage these questions and makes it so that when you tell someone who's interested in the well-being of our country and its financial system about these strange curiosities, the Federal Reserve banks, it would help so much to be able to tell them that those with the largest banks do not participate in that governance.
Right. And would you like to add something to this, Ms. Rodriguez-Vallardes?
Yes, I've actually looked at both pieces of bipartisan legislation, and I am impressed with them. I agree with Dr. Conti Brown that I think it would be a very good idea not to have any bankers at the boards. The skill sets that they bring can be found elsewhere, and frankly, there's a danger of having too many bankers on the boards. You really need cognitive diversity. They would be much better served if they had somebody, let's say, from an independent broker-dealer that has nothing to do with the Fed, for example. They could have people there from the American Red Cross or such organizations that are experts at dealing with chaos and unexpected problems. You frankly would need a scientist. So there's a lot of different skill sets. There's a lot of value in cognitive diversity that's very, very important. And like these gentlemen, I concur with them that an inspector general who would be appointed by the president and confirmed by the Senate would be a much, much better situation. It is very, very difficult to go tell the people with whom you're working and you see on a day-to-day basis that they're doing a bad job. And the minute that you hear the word bonus anywhere, it immediately means that your own salary depends on their performance. And so you can't call out wrongdoing in an independent way, and you're not accountable to legislators.
I appreciate that. If you all will bear with me, there's one more issue I want to make sure that we get covered, and that is ensuring that the Fed and the Reserve banks are more responsive to requests from Congress and from the public about information. Right now, despite their massively important role in shaping our economy, Federal Reserve banks are exempt from the foundational transparency law, the Freedom of Information Act, or FOIA. So you all have relevant expertise, and I just want to go down the line, if I can, on this. Do you agree that subjecting the Federal Reserve banks to FOIA, just like the Fed board, would help strengthen the accountability of the Fed? Dr. Conti Brown?
Unequivocally, yes.
Yeah. Dr. Kupiec?
I testified yes.
Yes, I heard you, but I want to get it on the record. And Ms. Rodriguez-Vallardes?
Because right now, banks only report relevant risk measures once a quarter. By the time that we all get that information, it's old. So yes, I definitely would support the FOIA.
Good. And in the first panel, the Fed IG, who was chosen by the Fed chair, who answers to the Fed board, and who can only be removed by the Fed board, argued against making the Fed IG a Senate-confirmed position. I think you all have answered this at different points, but I just want to make sure I get this on the record. Do you agree with Inspector General that the Fed does not need a Senate-confirmed IG? Dr. Conti Brown?
I disagree with him on this.
Yeah. Dr. Kupiec?
I don't think he made a strong case.
Okay. And Ms. Rodriguez-Vallardes?
Right, I disagreed with him as well. He didn't provide any evidence as to why particularly the role should be under the Fed.
Yeah. So the failure of Silicon Valley Bank and its crisis triggered an opportunity for Congress to finally bring greater accountability to the Fed, and we can do that from top to bottom. This hearing has discussed multiple bipartisan bills that would strengthen oversight and transparency, eliminate conflicts of interest, and make the Fed work better for the American people. It is time to end the Fed's culture of corruption. Thank you very much. I want to thank you all for participating. I appreciate your well-prepared opening statements. We'll make them part of the record. Questions for the record are due 1 week from today, Wednesday, May 24th. For our witnesses, you'll have 45 days to respond to any questions. Thank you again, and with that, this hearing